Welcome to the last bit of IAS 37, Provisions, Contingent Liabilities and Contingent Asset. The lecture plan for this video is we're going to discuss contingent liabilities and contingent assets. Then, what is a contingent liability? On this note, you need to be made aware that there are two possible contingent liabilities, and when we ask you in a theory question, you need to clearly identify which contingent liability it is. I will explain it to you now. The first option is it can be a possible obligation that arises from past events whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events that is not wholly into the control of the entity. Or option 2, it is a present obligation that arises from past events, but it is not recognized because it is not probable that there will be an outflow of economic benefits, or the amount of the obligation can't be measured reliably. This means that it was a provision, but it did not meet the recognition criteria of a provision, therefore it could not be recognized. Then the link with provisions, in essence, all provisions are contingent liabilities, but provisions are more certain, while contingent liabilities are not yet obligations, or they are obligations that do not meet the recognition criteria. A contingent liability can become a provision as more information becomes known. Then the accounting treatment of a contingent liability, it is not recognized, it is only disclosed in the notes, and if the possibility of the obligation arising is remote, you do nothing. That means no disclosure or no recognition. If you are jointly and severally liable for an obligation, you recognize a provision for your part and you disclose a contingent liability for the rest. For example, if you and another company are sued by the same company because of infringement of copyrights, you will, for your part, that is a provision, if it is likely that you will pay, that it is a provision because it's likely that you will pay, you will recognize a provision for your part, but for the other company, you disclose a contingent liability. And at the end of each reporting period, you assess whether a contingent liability can now be recognized as a provision or needs to still be disclosed as a contingent liability. Then, because it's disclosure, you only disclose that you need to disclose certain things. And this is for each class of contingent liability, you disclose the description, the estimated financial effect, the uncertainties about the amount or timing of outflows, the possible reimbursements, if there is anything. And remember, if the probability is remote, you do no disclosure, and therefore you also don't recognize it because it can't be disclosed as a contingent liability. It also can't be recognized as a provision. And then, in case number 1, just that for you again, some of you might have wondered, but what if the 300,000 Rand could not be estimated reliably, or the opinion, or the lawyers were of opinion that they will not lose the case? What will be the effect? Now, if I tell you that the 300,000 could not be measured reliably, but the lawyers are of opinion that ABC will lose the case, it is the second part of contingent liability because it is a present obligation, but the amount can't be measured reliably, therefore it did not meet the recognition criteria of the provision, therefore it could not be recognized as a provision, therefore it is only recognized as a contingent asset as a present obligation. Then, if I told you that the amount of 300,000 could be measured reliably, but the lawyers are of opinion that they will not lose the case, it will be the first definition of contingent liability, a possible obligation that arises from past events whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, because you don't know if you will lose it. And remember, as I've told you, I've clearly stated which of the contingent liabilities it is. If it's a possible obligation or a present obligation. Always remember to do it in your theory questions. Then contingent assets. Luckily, there is only one definition. It is a possible asset that arises from past events whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events that is not wholly within the control of the entity. And then also, contingent asset is not recognized. It is only disclosed when it is virtually certain to be received. You will recognize it as an asset. And at the end of the reporting period, you will need to assess if you need to disclose it as a contingent asset or recognize it as an asset. As it is only disclosed, what do you need to disclose? A description and an estimated financial effect. So remember, as a summary of IAS 37, if there is a probable outflow of resources embodying economic benefits, when it's probable, you recognize a provision. When it's not likely, you disclose a contingent liability. When it's low, you do nothing. When there is improbable inflow of resources embodying economic benefits, when it's virtually certain, you recognize an asset. When it's probable, you disclose a contingent asset. When it's not likely, you do nothing. On this note, it's very important when we ask you a theory question about IAS 37 to be sure of the component that you're discussing. Do you discuss a provision, a contingent liability, or contingent asset? Because if you discuss the wrong component, you won't get any marks. And remember, a provision, it is probable. And for a contingent liability, it is not likely. And for a contingent asset, it is probable. Then you disclose a contingent asset. But when it's virtually certain, you recognize an asset.